Hey everyone, it's Matt here. Welcome back to another episode of Money Talk. You'll never learn unless you make mistakes. And investing in trading is definitely not an exception to that rule. Some investors look for short-term and quicker gains on investments, while some formulate a steady long-term strategy. However, no matter which way you decide to go, there are definitely lots of areas where you can make mistakes. Of course, anyone is bound to make investment mistakes, but some of these mistakes can be costly, so the point of this video is to try and help reduce the chances of you making these types of mistakes. Now let's admit it, nobody's perfect, not even the investment gurus. But repeating the same mistakes or not learning basics before betting your hard-earned money is foolish. So today I've put together 7 common mistakes that you must avoid as a beginner. Let us know if you made any of these mistakes. As always, if you have any questions as you watch this video, feel free to leave them in the comments down below. If you enjoyed this video or found it helpful, don't forget to hit that like button and subscribe to this channel for more videos. Let's jump into it. The first mistake we're going to look at is investing without learning. You don't need to be an investment analyst, but jumping into trading without learning can be disastrous. You'll need to consult a professional at some stage anyway. The best time is to consult one in the beginning. Stock investments are always riskier options, so learn about basic but significant investment methodologies. For example, learn how you can use limit loss and stop loss orders to minimize your losses on a given day. Commissions, margins, and spreads make up the real trading costs. The more you learn, the better off you'll be. Mistake number 2, starting without a plan. You can formulate an effective investment strategy only if you have clear goals in your mind. Trading for earnings is different from investing to fund a house mortgage in 5 years. You may plan to invest for a longer period, for example, to support your retirement funds. Investments are usually considered long-term plans. It means a stock's performance in a 2 to 3 year span will not affect your plans. However, it will require significant research and planning to invest in stocks that can perform in the long term. Another common mistake is following the crowd. Beginners make this investment mistake quite often. They run with the crowd. It may not be a bad idea to follow the market trends, but it doesn't work automatically. Always perform due diligence before investing in trends. It all boils down to market news. Unfortunately, crowd trends often fail to investigate deep down in an industry. By the time you'll realize your mistake, it could have already wiped away your investment. Never let your emotions overcome your intelligence in investment decisions. Another common mistake we're going to look at is trusting the wrong sources. To be frank, it can be extremely difficult for you to distinguish the crooks in disguise while you're still naive. There's no shortage of so-called experts and investment analysts on the media. Social media, affiliate marketing, and personal blogs have made this even more confusing. Remember, most of these half-cooked experts are selling stocks to you for earning commission. They have vested interest as well. Trust your intelligence. Perform your proper due diligence on the source of information by checking its historical performance. Next, we're going to look at investing without assessing risks. This is another big mistake that beginners make while investing. You can borrow money for investments, you can fully utilize and leverage the opportunity of an offer, but it can end up as a disadvantage for you as well. It's a common pitfall to think about the risk-reward relation at this stage. Some stocks are highly volatile and riskier than others. Understand your risk tolerance and risk appetite first. Think about how much money you can afford to lose and how much you want to invest. Buying too much on margins is another very common mistake. Buying on margin is buying on borrowed money. Beginners often get carried away with margins as if it's free money on offer by the brokers. You'll incur hefty interest charges, commissions, and management fees by utilizing the margins. More importantly, you'll need to repay the brokers if you go overboard. Leverage also comes as a two-sided sword. It accelerates your profits when used wisely, but it can also magnify losses manifold too. Avoid using the leverage without understanding the risks involved. And last but not least, we're going to look at portfolio management mistakes. Diversification remains only one part of the portfolio management. With index funds, ETFs, and mutual funds, you can build a balanced portfolio by yourself. Never begin with risky individual stocks on their own. Even if you put money on individual stocks, put your money on what you fully understand. A wiser option would be to put a major portion of your investment in index funds that allow diversification naturally. It will hedge your risk, and you can experiment with the remaining investment as you learn. So there we have it. We've gone through 7 beginner common investment mistakes. As always, if you still have any questions, feel free to leave them in the comments down below. If you enjoyed this video or found it helpful, don't forget to hit that like button and subscribe to this channel for more videos. Thank you for watching.